Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing CRISPR stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. CRISPR is a gene editing company focused on the development of CRISPR-based therapeutics. CRISPR stands for clustered, regularly interspaced, short palindromic repeats. It is a revolutionary technology for gene editing. It alters specific sequences of genomic DNA. The company plans to use its technology to disrupt, delete, correct, and insert genes to treat genetically defined diseases and to engineer advanced cellular therapies. The company is headquartered in Zug, Switzerland, and was founded in 2013. It also conducts R&D in Cambridge, Massachusetts. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, $5 billion market cap. They're trading at $66 a share, and they have 77 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looks really good in 2021, $457 million. It was negative in 2020, positive in 2019, and negative in 2018. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative, positive, negative, positive. Revenue is a sales for the company, and they had pretty much no revenue in 2018 and 2020, but a decent amount in 2019 and a pretty big number in 2021, over 900 million. This is the company's income statement. The top line is the revenue, the sales. Below that is their operating expenses. Research and development is their main operating expense. Revenue minus operating expenses gives you your operating income, and that was highest in 2021 at 373 million. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. The gain on the sale of an investment is an example of something in this category. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is their net income, which was the highest ever in 2021 at 378 million. This is their income statement from their annual report. Most of their revenue was from collaboration, 913 million. They do receive a good amount of grants. That was close to 2 million. So their total revenue was 915 million. A lot more than last year, under 1 million. But in 2019, it was 290 million. 900 million of that revenue was from A&R Vertex. Another 12.5 million from the 2019 milestone payment with Vertex. They spent 439 million in R&D, 102 million in general and administrative expenses. So they had lots of operating income in 2021, 374 million. Their earnings per share in 2019 was $1.23. Then it was negative 5.29, but in 2021 it was close to $5. And they add about 10 million shares of stock each year. They had 54 million in 2019, 66 million in 2020, and then 76 million in 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. They generated 539 million of cash flow in 2021. Then you have CapEx, investments in property, plant, and equipment. That was 82 million. Operating cash flow minus CapEx gives you your free cash flow. And they had a lot of free cash flow in 2021, but it was negative in 2020, so they're mainly funding their business on capital stock. They raised 307 million in 2018, 415 million in 2019, then 982 million, 213 million. Every time a company issues common stock, it increases the shares outstanding and makes your shares less valuable. This is their operating section on their statement of cash flows. The way to calculate operating cash flow, you start with your net income. That was 378 million. We add back 18 million of depreciation and amortization. This is a non-cash item that brings down your net income, but we add it back here. We have to add back 100 million of equity-based compensation. This is when they give stock to their employees. Since it's a non-cash item for the company, we add it back here in the statement of cash flows. We add back 14 million of amortization. Then we have to adjust for changes in working capital. They bought $37.5 million on credit from their suppliers, so that's a cash inflow. But when they pay for those products or services, then it'll be a cash outflow in that accounting period. Even though they reported a net profit of $380 million, they actually generated nearly $540 million of cash flow. This blue line is their revenue since 2016. So you can see they had very little revenue up until 2021. But most of that revenue in 2021 was an upfront payment, so it may not be recurring. In order to get a drug approved by the FDA, it's a long and arduous process. This is their investing and financing sections on their statement of cash flows. In their investing section, they spent $82 million in PP&E, and they have a lot of cash on their balance sheet, so they spent $1.5 billion in marketable securities. These are usually short-term liquid investments, so they could earn a little interest on the cash. And $500 million of those investments matured, so they had a cash outflow of $1 billion in their investing section. In their financing section, they raised $213 million from selling common stock, and they raised $38 million from selling stock to their employees. ESPP is Employee Stock Purchase Plan, and they also sold options. In their financing section, they had a cash inflow of $251 million. Last year was a cash inflow of $1 billion. This is the equity section on their 12/31 balance sheet. They have $2.4 billion of equity. They raised $2.6 billion from selling their business, and they lost about $200 million from running their business. Let's look at the capital structure. They have $2.4 billion of equity, $225 million of debt. They're 91% equity, 9% debt. And they could pay off all the debt with the cash on their balance sheet and still have $2.2 billion of cash left over. This blue line and the green line are pretty much the same each year. The blue line is their equity balance since 2016. The green line is their cash balance. And they have almost no debt. The reason my Excel spreadsheet says they're 9% debt is because I'm looking at all debt. This chart is just focused on long-term and short-term debt. I gave them the highest whack on Finbox, 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $8.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6.5 billion. We divide that by 77 million shares. And we get a calculated stock price of $88. They're trading at $66, so they're trading at a 22% discount. It's a buy according to the model. The forecast is for the company to hit $604 million of revenue by 2024. That's how I got their revenue for 2024. The 2022 target is $11 million. This is the end of 2022. And the 2023 is $189 million, which is right here. These are the company's targets. If they do hit these numbers, I think $1.2 billion in 2025 would be possible. So that's how I got their future revenue estimates. In 2019 and 2020, they converted 42% of their revenue into free cash flow. So I multiplied their future revenue estimates by 42%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $144. They're saying it's 55% undervalued. 12 analysts priced this stock, and the average price target is $110. The low is $64, the high is $170. This is where the stock has been trading the last 5 years. So it was pretty low back in 2017. Then it got up to $200. There was a huge run up at COVID. It was under $50, and then it went way up. Just a couple of weeks ago, it was getting close to $50, but that may be the resistance point because it looks like it's coming up from the bottom. I found 6 other companies that work with CRISPR gene editing, but I couldn't fit all 6 on this sheet. I could only fit 3 others. Of the 7 total companies that work with CRISPR Therapeutics, these are the 4 largest. These are their stock price movements of past 5 years. Beam is up 550%, NTLA 340%, the company we're looking at 239%, and Edit down 13%. If you compare this company to the S&P 500, this company is up 376%, and the S&P is up 108%. They have a pretty high beta, 2.01, so the stock is really volatile. It moves 2 times the market. It's gone down 48% in the past 52 weeks, while the S&P is up 7%. The 52-week low is 51, the high is 170. and the stock is trading slightly above its 50-day moving average, but well below its 200-day moving average. Only about 1.5 million shares are traded each day on this stock. Of the 77 million shares outstanding, 73 million are on float. 58% are held by institutions, and it has a really high short percentage. Nearly 19% of the shares are shorted. They employ 473 people, and their employee count has been going up little by little each year. The CEO's salary is $625,000, and their total compensation package is over $9 million. This is as of the end of 2020. It's the latest info I have. If you invested $10,000 into this company when they started trading, you would have $46,000 today. That's a 363% total return, a 32% annual return. But at its peak about a year ago, you would have had about $130,000. 61% of the company is held by institutions, 38% by the general public, and 1.3% by insiders. Their biggest investor is ARK at 12%. That's Kathy Wood's fund. The next biggest is Nico Asset Management, Capital Research, SR1, and New Enterprise. Let's look at their financial ratios. They have a good PE at 13.4. That's stock price over earnings per share. Price of sales is decent at 5.5. That's stock price over sales per share. And a good price to book of 2.1. That's stock price over book value per share. And their price to free cash flow is 11.1. Let's look at their non-current assets. 138 million of property and equipment, 17 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose, like for example to acquire another company. 174 million of operating leases. If a company leases something, say for example a building, they report that as an asset and liability on their balance sheet. Let's look at their non-current liabilities. They have 12 million of deferred revenue. Deferred revenue is when a customer prepays for a product or service they're going to receive in the future. And they owe 213 million on their leases, and they have 7 million of other. They have a really high return on invested capital of 122%. That's operating income times 1 minus the tax rate over equity plus net debt. They have a high ROE of 16%. That's net income over equity. And they have a really high current ratio of 20.2. That's current assets over current liabilities. Let's look at their current assets. 920 million of cash, 1.5 billion of marketable securities. Here's a breakdown of their marketable securities. 16 million of US Treasuries, 1.2 billion of corporate debt, 45 million of CDs, 13 million of government securities, and 213 million of commercial paper. All of these assets are highly liquid and low risk. And they have 38 million of prepaid expenses. This is when a company makes an upfront payment for product or service they're going to receive in the future. Let's look at their current liabilities. 15 million of accounts payable. This is how much money they owe their vendors. 91 million of accrued expenses. Accrued expenses are expenses the company has incurred but it has not paid it yet. Here's a breakdown. 24 million of payroll, 48 million of research costs, 4.7 million of professional fees, 6 million of intellectual property, and 7 million of accrued property and equipment. Over the next 12 months, they owe $12 million on their operating leases. They generated 457 million of free cash flow in 2021, and they have 2.3 billion of working capital. So it looks like the company is well capitalized. They should have enough money to get through the next 12 months without taking on any more equity or debt. The best way to look at ratios is to compare them to companies in the same industry. There are 753 companies in the same industry as CRISPR, and these are the top 15. CRISPR ranks 29th in market cap, and these 6 companies below CRISPR also work in CRISPR gene editing. So these are their direct competitors. And CRISPR is better than average in every single category. They have hardly any debt. They're generating positive free cash flow. It was mainly due to that large upfront payment. Their market cap is higher than average. And of the CRISPR companies, they're the largest. They have really good price multiples in 2021. And their 3-year annual growth rate is phenomenal, 564%. So to summarize, I have them trading at a 22% discount. But it's so hard to value a company like this because it's so dependent on if they're going to develop a drug or not. Some companies can go 10 years without developing any drugs and never bring any revenue. The only thing we can do is track the company, see how they're doing financially, and try to monitor how many drugs they have in a pipeline and to see how far they are in the process. This is definitely not in my wheelhouse. I'm more comfortable valuing a company that has consistent revenue streams and a company that I understand their products. So feel free to leave a comment if you have any suggestions. I rank their free cash flows, revenue, and ratios 8 out of 10, so let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.